March 10, 2000. The Nasdaq Composite Index hits 5,048 points. Tech stocks are worth more than the entire GDP of most countries. Companies with zero revenue are valued at billions of dollars, and Wall Street analysts are telling investors that profits don't matter anymore because we're in a new economy where old rules don't apply. But over the next 30 months, $5 trillion in market value will evaporate. Hundreds of dot-com companies will go bankrupt, and millions of investors will learn the hard way that there is no new economy, just the same old greed and delusion wearing a different costume. If you want to understand how technology bubbles work and why eyeballs and clicks don't pay the bills, hit that subscribe button and drop a comment about what financial crisis we should cover next, because the dot-com crash of 2000 to 2002 is happening again right now in crypto, AI stocks, and whatever the next supposedly revolutionary technology will be. The bubble started in August 1995 when Netscape went public. Netscape made web browser software and had never turned an annual profit. But on the first day of trading, the stock went from $28 to $75, giving the company a market value of $3 billion. This was insane by traditional standards, but it signaled to everyone on Wall Street and in Silicon Valley that internet companies were the future, and profits didn't matter what. Mattered was growth market share and getting big fast before competitors beat you. The logic seemed compelling at first. The internet was revolutionary. It would change everything about how people communicated, shopped, and did business. So companies needed to spend heavily to acquire customers and build market share. And once they dominated, their market profits would follow naturally. This was called the Get Big Fast strategy, and it turned the venture capital world into a money printing machine. Any entrepreneur with a business plan that included .com in the name could raise millions of dollars from investors who were terrified of missing the next Amazon or Yahoo. The mania accelerated in the late 90s. Companies like Pets.com raised hundreds of millions of dollars to sell dog food online. They spent millions on Super Bowl ads featuring a sock puppet mascot. But they were losing money on every transaction because shipping heavy bags of dog food to individual customers cost more than the revenue from the sale. Webvan raised $800 million to deliver groceries. They built massive automated warehouses before they had proven the business model worked, and when customers didn't materialize in sufficient numbers, they burned through all their capital and collapsed. Cosmo.com promised to deliver anything within an hour for free. They hired thousands of bicycle messengers and spent millions on infrastructure, but the unit economics made no sense, and they went bankrupt. Wall Street analysts became cheerleaders for the bubble. Henry Blodgett from Merrill Lynch and Mary Meeker from Morgan Stanley would issue research reports with absurd price targets for internet stocks. They'd value companies based on eyeballs and page views instead of revenue and profits, and they'd tell investors that anyone who didn't understand the new economy was stuck in old economy thinking. The conflicts of interest were massive. These analysts worked for investment banks that were earning huge fees from taking .com companies public, so they had every incentive to keep the bubble inflating. Stock valuations became completely detached from reality. Companies that would never make a profit were valued at billions. Day traders were quitting their jobs to trade internet stocks full-time, and everyone had a story about someone who became a millionaire overnight from buying the right IPO. The fear of missing out was overwhelming. People who raised concerns about valuations were dismissed as dinosaurs who didn't understand technology, and the Federal Reserve Chairman Alan Greenspan's warning about irrational exuberance in December 1996 was ignored as tech stocks doubled again over the next 3 years. Behind the scenes, massive fraud was taking place. Telecom companies were borrowing hundreds of billions of dollars to build fiber optic networks that nobody needed. They were booking revenue from selling network capacity to each other in circular transactions that inflated their reported sales. And executives were getting rich from stock options while the companies burned through capital. WorldCom, the second largest long-distance phone company in America, was caught inflating its profits by $11 billion through accounting fraud. The CEO, Bernie Ebbers, was eventually sentenced to 25 years in prison. The crash started in March 2000 when the Nasdaq peaked at 5,048. Investors started asking uncomfortable questions about when these companies would actually make money. Venture capital funding began to dry up, and .com started running out of cash. Pets.com shut down in November 2000, just 9 months after its IPO. The sock puppet was retired, and $268 million in investment capital was gone. Webvan filed for bankruptcy in July 2001, laying off 2,000 employees and destroying $800 million in shareholder value. The carnage was extraordinary. The Nasdaq fell 78% from its peak, dropping from 5,000 to 1,000 over 30 months. $5 trillion in market value evaporated. More than 200 dot-com companies went bankrupt, and hundreds of thousands of workers lost their jobs. But here's what's important. Not every internet company failed. Amazon survived by actually building a real business. With positive unit economics, Google became profitable by creating an advertising model that worked, and eBay succeeded by taking a percentage of transactions without holding inventory. The lesson from the dot-com crash is simple. Technology changes things, but it doesn't change the fundamental laws of business. Companies need to generate more revenue than they spend. Growth without profitability is just a path to bankruptcy. And when analysts start telling you that old rules don't apply, that's exactly when you should be most skeptical. Alan Greenspan lowered interest rates to combat the recession that followed the dot-com crash. That cheap money helped inflate the housing bubble that would explode in 2008, proving once again that the solution to one bubble often creates the next one. If you found this valuable, make sure to subscribe and share this with anyone who's investing in unprofitable tech companies today, because the patterns from 2000 are repeating themselves in modern markets, and the people who don't learn from history are condemned to lose their money the exact same way.